LinkedIn, YouTube, Twitter, Facebook, and in person. So let's get started here. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and I'm joined with my good friend Tim Baker. Hey, Tim.
Hey, Kirk.
Glad to have you here. Gonna mix it up a little bit. Doug's on vacation. Brought in Tim as a welcome, fresh new face here. Uh, it's been a little crazy, but I think we had some. We were planning on talking about all these topics, and then we had the kind of war breakout in the Middle East, unfortunately. So, kind of throws things for a little bit of a loop. But I think we're still going to get to the topic at hand. But I did want to point that out because it obviously is a big deal, and I will point out a few frameworks to think about because I actually have at least one client who lives in Israel, so I have a good understanding of kind of what's going on over there. But I think the reality is this is a new event, much like the war in Ukraine, and people will jump to make decisions based on that, and we have no idea where this is going to go. This is something that could be short. This is something that could be long and drawn out, and it's really hard as they, I hate to use it. It's kind of excuse the pun, but it's the fog of war, right? So when things happen, you don't really know what's happening until later. Like, oh, that happened. But in the moment, you get a lot of information that may be a little bit biased. And I've been seeing some reports out that are biased one way or the other, for or against Israel. And so I think you just got to take everything with a grain of salt this early, but it is an important marker. And I'm going to ignore the obvious fact that there's a lot of people died because that's not what this show's about. We're talking about the financial impact. And so I don't want to belittle that, but there's enough people talking about that. And the horrors of war are terrible. So I don't want to dive into that. But I do want to point out that this will have an effect on markets. Oddly enough, it seems to have boosted the markets, which is kind of interesting. People were afraid that there was going to be a big sell-off, and there was a little sell-off, and then it bounced back. So I don't want to say it makes you wonder, but it's interesting that has had almost no impact on the markets. So, but people have been speculating that that's going to cause oil prices to rise, and I would say even that we don't know yet. And oil prices have been pretty high, and for other reasons, and this could make things worse. This could cause oil prices to climb, but as we know in the market, sometimes it does the opposite of what you think it should. So I would just take everything with a grain of salt at this point, not to belittle the situation, but to we're just talking about the markets. The markets seem to have shrugged that off as if it's nothing. Now it could get worse, but just keep in mind that the markets are not reacting to it in the way that you would normally think in a rational investor would handle that. So Tim, what do you see is going on in the world here? What we're talking about credit events, but like, what do you see is going on? What do you think is interesting to the listeners?
Yeah, I mean, first of all, it's obviously a shame about what's going on over there, whatever your area of support is. It seems like, as a species, we just can't stop doing this to one another. But I think you raise a good point, which is, these things happen. They're considered major events and they dominate the headlines. And I actually was sending an email to a student that had asked me to weigh in on AI in the financial services industry. And I made the same point that you and I talk about over and over again, which is I'm very wary of anything, whether it's AI or human beings trying to make a prediction about what the future will be. And as you rightly point out, we went through the same thing when Russia invaded Ukraine. The market reacted very briefly, and then it just kind of went about its way saying, okay, well, this is probably just going to be a protracted thing that now exists. So I was interested that the invasion of Israel did not have that immediate sort of negative impact on the market. And as you say, the markets have actually done quite well. The S&P 500 is up another half a point or 0.5% this morning. I think what's dominating everybody's minds is let's get back to the fundamentals. And we spent prior to last week, we had spent the prior 6 weeks with the market in a little bit of a tailspin. The S&P 500 was down about 6% or so over that 6 week period, and to me that was much more dominated by the threat of a credit event, which was interest rates spiking way more than anybody thought they would. It's funny, when I worked at BlackRock, I'll never forget sitting on the desk with this portfolio manager, and this was back in 2011, saying, we're never going to see 4% on the US 10-year Treasury ever again. And at the time, I was like, you know what, that's probably true. We're in a period where the Federal Reserve has much better control over inflation and all of their toggles. You probably won't see that again, barring a big oil spike or whatever. And here we are at, and actually rates have bounced back quite a bit over the last day or so. But we got up to over a 480 on the 10-year Treasury. And, for everybody's perspective that doesn't remember, back in 2020, during the peak of the COVID crash, the yield on the US 10-year Treasury was lower than 0.5%. So when we talk about credit events, and we can probably get into whether or not you or I think one is actually coming, that's the problem, right? Whether it's a credit event for homeowners, whether it's a credit event for corporations, the government, whoever it might be, when interest rates go from less than 0.5% to almost 5%, that's a massive shock to the system, especially for those folks out there that have adjustable rate mortgages, loans, whatever it might be. So this, to me, is, I still think, and I know it gets boring because it's basically what we've talked about for the last 2 almost years, but I do still think the market is very focused and watching every single data point in terms of inflation and the economy. That actually surprised me more. Friday was a booming jobs report for the month of September. We added close to double the number of jobs that everybody thought we were going to in September. And the market sold off almost immediately and then rallied back later in the afternoon. And I think that was driven more by the fact that the unemployment rate actually ticked up and wage growth ticked down. So wage growth is really what the Federal Reserve is focused on right now, because that's what they consider to be inflationary, right? More dollars chasing, the same amount or fewer goods. So I do think October 30th is going to be very much on everybody's mind for the next couple of weeks to see where the Federal Reserve goes. But in terms of what worries me, I do worry a little bit about yields being this high. Mortgage rates are at or over 8%, depending on your credit score. And companies are going to have debt to refinance. I've got a line of credit that was originally issued at 7%, and now it's 10.25%. That has a huge impact on my monthly interest payments. So that to me is, that's a very long-winded answer to what do I find interesting. The potential credit event is one that I'm thinking about.
Yeah, and I want to kind of get into what is a credit event as well, because I think it's really important. But I did want to point out something, and I'm pulling up a chart here for those of you who are watching, and this is coming from a presentation that I give occasionally, which talks about bonds. And we've had low interest rates for such a long period of time that people forget that bonds are risky. Everyone thinks bonds are safe. We have a whole generation of people who think bonds are safe. And, pretty much for the last 30, 40 years, 43 years, bond yields peaked in 1980, 82, 81, depending on which bonds we're talking about. And they peaked and they've gone down ever since. So maybe it's 42 years, right? So, but if you look at that, they went from a high, depending on what you're in, of 15 to 20%. The 30-year Treasuries, I think, got up to 15%, and some other bonds that get even higher. But 15% is pretty high. And then it went down to 1%, 0%, depending on what you were looking at. Now, if you look at this chart, the reason I show this is that if you go from a 13% to a 14%, you're looking at a 7 to 7.5% change in value of your bond. But if you're going from a 1% to a 2%, you're talking about a 24%, 24.6% change in value. Now, the reason that bonds were risky, and this is one of the reasons that some of the banks like Silicon Valley Bank and Signature Bank and First Republic went down, is because they owned a lot of long dated, low interest rate bonds. So when the rates went up, the bonds lost value, significant value in some cases. And what happened is people wanted to pull their money out, which means they had to sell them. And when you liquidate it, that basically causes a run on the bank because the banks are leveraged. And if the banks were not leveraged, there would be no problem. They would lose money, and it is what it is. But because they're leveraged, they lose lots of money and eventually go bankrupt if enough people pull their money out. And that's what happened in the Great Depression with the bank runs. The FDIC solved that in that it gave everybody a a kind of a barrier that, oh, my money is safe, I don't need to pull it out. As long as you're not pulling money out of the bank, then they should be able to weather this, even though they might not make money. They'll be able to weather it. But when you start pulling money, that's what causes the banks to go under. Now, the importance of this is, if you look at this, the 30-year is very dangerous at 1%, right? Uh, the 10-year a little less dangerous, but you're still losing money, right? So effectively, if you're looking at a credit event, right, and a credit event we can define as some event that through massive defaults or restructuring cause the market to react significantly, right? So if you start to see, trying to think of how to define this. So if you start to see you start to see corporate bonds start to default, right? High yield bond market defaults across the board. Let's just say that happens. I'm not saying it's going to happen. Let's say it does happen. Then you're going to see some significant money flows moving around, and that's going to cause the markets to, I don't want to say crash, but it probably will cause the market to crash. The U.S. government decided to default on their debt. That would be, I couldn't imagine a scenario worse than that right now because no one's prepared for it. So there's a few different pieces to keep in mind here. One is the fact that there is a default of significant size. So if Acme, I don't know if Acme is actually a company, but if I'm going back to the Roadrunner cartoons, Acme Corp, if they default on their debt and they have like 5 million in debt, no one's going to care. But if they're 5 billion or 5 trillion, all right, now we got a problem, right? And so the size of the debt default is really important. Um, Also, it's what else is tied to it. So if you think of the U.S. government, everything's tied to U.S. government debt, right? So if if U.S. government debt defaults, I'm not saying it will. There's actually extremely low probability that will happen for many reasons, which I won't get into now. But if that were to happen, it'd be mass chaos because everyone's dependent upon that. So, like I said, it's not going to happen in the short term. I know a lot of people sell the fear that it's going to happen. But frankly, yes, it's possible, but not tomorrow. Might happen 10, 20 years from now, but it's not happening tomorrow. So just keep the time frame in mind. Um, and I would also think about the interrelationships. So what a lot of people talk about. So think about like mortgage bonds, right? You think about um, there were some events in 2020. I'll give you an example. Sometimes these credit events are caused by other things. So 2020, I think it was, I can't remember the exact date, but it was right near the bottom of the market in 2020 after COVID. And what happened was there was a mortgage REIT fund that liquidated all of the mortgage bonds in their fund. Everything just liquidated all at the same time. And you had all these mortgage REITs. You had the price of the market crash and dropped. I forget what it was, like 50% or something crazy. And I was talking to a friend of mine. He looked into it, and he's like, "Well, actually, this is only happening because a fund is liquidating everything at the same time. They're dumping it on the street. So basically, they're mass selling, which causes a panic, which causes the price to go down because there's not enough buyers. So it pushed the price down, and then within a week or two, it went back to where it was before, and you could have made 80 to 100% in a matter of a week or two. That was only because of a fund doing what they did, right? Now, it could also be caused by other events. So look at 2014, I think it was. I forget, it was 17 or 14, one of the two. I'll have to look it up. Anyway, the oil price, maybe it was four. I don't know. I'll look it up while we're talking. No, I think it was 17. So basically, oil prices crashed. They were up at $100, and then they went down to like in the 20s. And so the problem is you had a lot of oil producers that effectively took it on the chin. You had a lot of wildcatters that went bankrupt, and effectively you had a lot of oil producers that uh, basically issue high yield bonds. So they issue debt so they can go out and explore and pull up oil at $100 a barrel. You can make a lot of money, right? But what happened was oil went from $100 down to 20, the high 20s. All these people can't make money anymore, so they effectively would have to default on their debt. So the oil price dropping caused the extreme high risk companies to drop in value, their bonds as well as the equity drop in value, and then everything else started to spiderweb. This is what we call a contagion effect, right? So it started with oil prices, then went out to the speculative companies' debt, speculative companies' equity, then the non-speculative but maybe more established, they went down in equity, their debt start. So as you look, and I'm visualizing this, the spider web, things start to expand into other areas, and this is what happened in 2008. It happened in 2017, if I'm getting the date right. And basically what happens, the contagion effect, is when it starts with one thing and it spider webs out because of all the interrelationships. Now, eventually that stopped, and it stopped with three high yield bond funds or distressed debt funds freezing up their investors 3 days in a row. So day one fund froze and said you can't redeem your money. We will redeem it within the next 6 months. Day two, another one did it. Day three, another one did it. And this started to happen. I'm like, oh, this is not good. Now, for whatever reason, that stopped and didn't go any further. But that was a bad time. That could have potentially gotten much worse. Because if you think about it, what happens is, all right, well, I can't sell my oil stuff because it's too far down. I might as well wait till it comes back. I'm going to sell my Apple stock because that's liquid and I can get money from there. So that'll push the Apple stock down. Well, the Apple's down too low. I can't sell that, so I got to sell my GE or whatever. So the contagion effect, it starts in one area and expands out into unrelated areas only because people need cash. And so they sell anything that's liquid, which means that everything else goes down. This is why the markets overall go down, even though it's contained in one area. So that's where that we kind of get into this credit event, is when a credit event happens and we don't know where it's going to be, but if it happens, it can take down the market because of the interrelationships related to that one thing, right? If it's big enough and people need cash, they're going to sell other stuff, which brings it down. And then the question is, where does that stop? So I just kind of went in a rant, but I did want to describe what a credit event is or could be. And I want to be clear. I don't know what it's going to be, right? No one does. 2008, no one knew what the credit event would be. They knew where the bodies were, right? There were people, you saw the movie The Big Short, they knew where there were issues where they could make money at it. Hey, we short these these like piles of dog poop that are basically filled with garbage. We can short that. People think they're worth $100 and they're really worth two. We can short that and make a lot of money. But they didn't know the extent of the market until they started researching it. Like some of these people were surprised when they started researching it. So the point is, you don't always know where it's going to happen, but you know that something's brewing, and people are when the smart people start to get scared, it's a bad time. One more example of a credit event. I'm going to give it back to Tim. Long-term capital management. That's another example of a credit event. You had a lot of really smart people, and we did have Victor Hagani on recently, and he was actually working it. He was one of the principals of long-term capital management, so he has some good insight into that. But if you look at something like that, that was basically a bunch of really smart people who leveraged themselves 100 to 1, and the Wall Street said, "We're going to sweep the leg, Johnny, and we're going to take you out," and the whole thing went crashing down, and basically a bunch of wealthy people had to get together and bail them out because otherwise it would have taken down the system. So events like that happen, and you don't know where it's going to come from, but you know that it's bad, and you have to prepare for stuff like that. And we're starting to hear some mutterings of things going on that we have to be careful of. So I would just kind of keep that in mind. So Tim, kind of what are your thoughts on stuff like this?
Yeah, so just to help you out, I went back to find the chart because I was trying to remember what year it was too. It was actually pretty sustained. It was 2014 to 2016
Yeah.
that oil went from close to $120 a barrel down to about 28 to 30. But the other interesting thing is that I think everybody forgets, and I did too until I looked at this chart. Oil was negative in 2020.
Yep.
Oil was trading at almost negative $50 a barrel. So that was obviously a huge credit event as well. But I know I keep harping on this, but you keep saying it. So I'm going to keep jumping in when you do. The predictive ability of everything is zero. Right. So all the smart guys and Margin Call is another great movie that addresses some of the stuff that happens in The Big Short. And I love Michael Lewis. He's great and everything. But it simply points out the fact that the smartest people in the world figured out that this was going to happen after it was already happening. And in the early 2000s, I was a dumb 25-year-old. And so there was no way I would have known what I was doing. But I worked on Citigroup's collateralized mortgage obligation trading desk. And so, we're sitting there with all of these collateralized mortgage obligations going out to financial advisors and saying, hey, we'll get you 8% on a AAA rated bond. And everybody was going nuts and, hey, isn't this fantastic? And all of those good things. So there were definitely, we make the argument like nobody knew it was going to happen. That's not true. As you rightly point out, and The Big Short rightly points out, there were people that knew it was going to happen. But by the time they knew it, there was nothing you could do about it anyway, other than short it. Which most people didn't have the opportunity to do. So, yeah, I do think those credit events can have much bigger impacts on the markets than other things. So you look at like the little blips in the market over the years, in 2019, the yield curve inverted. In 2013, Ben Bernanke made a comment about tapering. And we had the taper tantrum when, he was saying that the Federal Reserve was going to start raising interest rates again. All of those things are more kind of short-term blips. As a guy who started my career, the first 12 years of my career in fixed income, I am biased to it is really, as much as everybody pays attention to stocks and AI and Bitcoin and all of those things, bonds rule the world. Bonds drive liquidity, credit default swaps, right? That was a big topic in The Big Short, which is basically like, I'm going to swap you exposure to this interest rate, and you're going to give me exposure to this interest rate. And when they imbalance, one of us is going to owe the other one money. But credit default swaps have a huge impact on liquidity. And so you look at maybe bad earnings or whatever the situation might be that drives the market down, nothing will drive the market down harder and cause more volatility than a drying up of liquidity. Because there are so many investors out there, right? Think about Bitcoin. This isn't something that gets talked about a lot. I mean, it gets talked about some, but not a lot. You think about Bitcoin, like most of those trades, when you see Bitcoin trading every single day, most of those trades are leveraged. People are buying $3 worth of Bitcoin for every dollar that they have to invest. And so that same thing is happening when they're getting out. They're liquidating $3 for every dollar that they had to invest. So that's why you get these big swings. And it makes me wonder, I don't follow it enough, so I'm not going to spend a lot of time looking into it. But it makes me wonder, like, what the background of trading looks like on Bitcoin right now, because it has certainly been less volatile than despite the fact that it's up pretty meaningfully this year and was down pretty significantly last year. But you've seen this kind of steadying of it if, people are just waiting to do something, or, the profile of the average trader has changed. But yeah, I think the thing that we can't know, we can understand the background, and every once in a while, there's an article flagging it as a big warning. If you look at the size of corporate debt globally and within the U.S., it's as high as it's ever been. And now interest rates are as high as they've been in decades. And that's going to cause a problem because, right, it's a very basic equation. Pepsi, Ford. I mean, heck, think about banks. Who relies on debt more than banks? Their balance sheet is a constant rotation of debt, both short and long term. And again, that's why you had the problems with Silicon Valley Bank and First Republic and all those other banks, is because they weren't matching their durations, meaning, they were supposed to have a 10-year treasury coming due that they had a payment going out, and instead it was coming due the following week. And so they had a mismatch. And we won't get into any kind of conspiracy theories, but my argument is the Federal Reserve oversees banks, and they're the ones that regulate them. So it was the Federal Reserve that was jacking up interest rates so quickly last year. It seems like maybe the Federal Reserve should have caught some of what happened to Silicon Valley Bank and First Republic and Signature Bank in 2020 before March of this year, but conversation for another day. So I do worry about what happens when some of these debt obligations come due. And you can take a look at, public companies have balance sheets that are available. You can just Google 10Q for Pepsi, and you can see their most recent quarterly report, and it'll give a breakdown of their short-term debt and their long-term debt. The long-term debt isn't the stuff that we have to worry about, because ideally interest rates will come down between now and the time those mature and they have to refinance them. But if you've got short-term debt coming due in the next 6 months to a year, you're going to have to refinance that at a much, much higher rate. So that to me is the thing that sometimes is worrisome. I'm like you, Kirk. I don't panic about these things. I don't worry about it destroying the world tomorrow. But I do worry about some of the things that can cause more volatility in the market. And I mean, I've been doing this for almost 30 years. And, I feel like ever since COVID started, you've seen more random volatility in the market. One of the things we used to talk about a lot on the team I worked on at BlackRock was not volatility, but the volatility of volatility. Kind of the second derivative of volatility. Like not only is the VIX or the volatility index going up or down, but then how volatile does the volatility index become? Is volatility changing much more every day than it used to? And I feel like that's been happening, and there's been more randomness to it. But for me, I tend not to worry about the short term. I'm sure you do as well, Kirk. Keep people focused on the long term, their goals, that sort of thing. But it's always good to be aware of these things.
Yeah, it can be really hard too. I mean, you make a great point. It can be really hard to keep perspective, and there's the aspect of time, which most people never really kind of keep in mind. So think about it this way, right? You've got this problem, right? U.S. has too much debt. We all hear about it every day. Too much debt. The U.S. has printed money. We have high inflation. Yada yada yada. Right? We talk about it a lot in the show. So great, that's happening. And most people think, oh my God, the U.S. is going to default in this debt. I need to buy gold. I need to buy Bitcoin. I need to put my money under the mattress. I need to do crazy things. All of that stuff's happening, but we don't know when the effects are going to be felt. So you might want to go out and buy gold. It could be the exact wrong time to buy gold, right? It's not just because you got scared. It doesn't mean now is the best time to do A, B, C, or D. Now, I bring this up because I see it all the time where they get caught in this fear cycle, right? Somebody scares the pants off them, some newsletter, some article, some podcast or blog or whatever. Like they read something, hear something, oh my God, the world's going to end. Okay, maybe it is, maybe it's not. I don't know. But you read an article today, your perspective is, oh my God, this scares the pants off me. I better do something. Well, that's important, right? It's important that you acknowledge that this is an issue. But the second step is, when is it going to be an issue? If it's an issue 100 years from now, who the heck cares? Now, it's not that it's unimportant, but it doesn't affect you today. 100 years from now, you're probably going to be dead. So it doesn't matter to you, right? Now, if you're looking at managing like generational wealth, all right, that's different. But for most people, 99.9999% of the people who listen to this show, then 100 years is not going to impact you. So don't worry about it, right? So we talk a lot about in the show and inflation, all these other things that are going on, and they're all really important, but they're not all really important today. So, for an example, there's a big problem brewing in the early to mid 30s where Social Security, Medicare, and pensions are all going to basically default, i.e., they're going to go to zero around the same time. Now, you want to talk about a credit event? That's a credit event. And when you have all of these big entities basically go to zero value, so if you think about a pension is a pool of money that is paid out to people over time and it increases in value. And, the numbers, there's a bunch of math in there, which I'm not going to get into right now, but basically the numbers are such that once you reach a certain point and you run out of money, you can't pay anybody out. Social Security has always been basically a Ponzi scheme because now we have fewer people putting in than are pulling out, and eventually that goes to zero with that math, right? Now, there's things they could do to lengthen the time period. There's things they can do to adjust, but the math is the math, and at some point, Social Security is going to run out of money. Okay, that's just the math. Somewhere around 32 to 35, depending on what they do. Pensions, depending on the pension, a lot of them, public pensions especially, are going to run out around the same time. Medicare, same thing. So that's a credit event. So if that's the case, if Social Security runs out of money, what are their choices? We can stop paying people, which is not really a choice, or they could print money. They could just print money to pay people. We're the U.S. government, and we can print money anytime we want, and we don't care because we're the world's reserve currency and we can get away with it. That's inevitably probably what's going to happen. Does that mean it's going to be a credit event? Well, not because of that, but if you have that Medicare and pensions defaulting all at the same time, well, it might be a bit of a problem, right? So think about the perspective of time. Am I worried about that today? Absolutely not, because we have 10 years to figure that problem out. Now, it'll probably take 9 years and 11 months before the politicians decide to do something because that's how politicians are, right? Kick the can down the road. But there are some things they can do to lengthen that time, extend the retirement age from 70 to 71, 67 to 69. There's things they could do, right? They could give you less of a pension. There's all these things that can happen, right? So the date 10 years from now is a problem, but within that 10-year time period, a lot of things could happen that could extend it and make it less of a problem. All sorts of things could happen. I'm not worried about that today. I'm thinking about it today. I'm not worried about it today. I'd be worried if it was next month. Then I'd be worried. But so I think keeping time in perspective is really important, because if you don't, then you get yourself wound up for no reason, right? And so people talk about the amount of money. Oh my God, we're going to have hyperinflation. Maybe, maybe not. That doesn't happen overnight. It actually, well, it happens in baby steps and then it happens instantly, is how people describe it. So it keeps happening and happening until one day it's like, oh my God, we have hyperinflation. I got to take my money out of the dollar and put it into something hard asset. But you've got a lot of time to prepare for that, because hyperinflation is not high inflation. Hyperinflation is a total distrust of the currency. That is what hyperinflation is. You can have 50% inflation, which is really high. You could have that, and we're still not necessarily in hyperinflation. Hyperinflation is when everybody totally distrusts the currency and they just say, I can't put my money here because it's worthless. So I need to put it into something else. And they just get rid of it. This is where, like Weimar Germany, people were like driving wheelbarrows full of of Reichsmarks to pay for a loaf of bread, right? Or Zimbabwe or Venezuela currently, or these other countries that have experienced this. This happens because people distrust the currency. Now, you could argue, well, I distrust the currency. Yes, but you're not 330 million people, right? There aren't 300 million people that distrust the currency. If that happens, we got a problem. So just understand that the time scale of things is really important to put things into perspective. And if you can't have a cool head, you need to find somebody with a cool head to help you. But it's really important, because fear and greed drive us all. They drive the markets, they drive market behavior, they drive portfolio values. And if you can't get control of your fear and greed, it's going to cause you to lose money. And that's why most investors lose money, is because their emotions get the best of them. And we're all human. Just the professionals have better tools, tactics, and resources to control their emotions. But we're all human, and we all are affected by the same thing. So, thoughts, Tim?
Um, Here's my thought, Kirk. In 2018, Venezuela's annual inflation rate was 15,657%.
Yeah, that's
So
normal.
yeah. So in the U.S., hitting a 9% interest rate after global economic lockdowns and reopenings is probably not your worst outcome. And the Federal Reserve's probably done a pretty good job of getting it under control. There's only so much they control. I always say, the Federal Reserve can't control oil. And so when Russia invades Ukraine, or any country that is a massive oil producer gets involved in anything, that's always going to be a spike. And frankly, it's why the Federal Reserve looks at that core inflation rate that excludes food and energy, which most of us are like, well, who gives a crap? I have to buy food and I have to buy gas. So why do I care what the number is, X food and energy? But just on your point, that is something that worries me a lot, and you already alluded to it, Kirk. I am a little bit frustrated at how frequently we, as participants in this economy and political system, have to deal with a government that basically acts like my teenagers did during high school, finishing up all of their assignments, at 6 o'clock the morning they're due. The fact that we continue to deal with debt ceiling issues and government shutdowns is a little bit sad. And, the fact that we kick this off to, I think it's November 15th is the next sort of deadline for funding for the US government. Once we even get that resolved, hopefully everybody didn't forget that by the middle of next year, that debt ceiling issue is going to come up again, because remember, we suspended it, we didn't raise it. So our government is going to have to figure out whether or not we're going to raise the debt ceiling. I do think there's something much more structural as opposed to cyclical involved here, where we as an economy, political or otherwise, need to get a better handle on how we manage these things from year to year. We're we're completely out of control. We're constantly winging it. So you talk about like a credit event, to me, like that would be the granddaddy, as you alluded to. A government shutdown, a government default. That's absolutely. That's like you say, that's chaos. That's the end of an economy as we know it. And I think my cynical answer to anybody that says, like, don't you think this is going to happen? Don't you think like our government is going to go away as we know it, and currencies and all of that stuff? And I say, you know what? Cynically, I think the government does what's in its own best interest, and the government is run by humans. And they're not going to let anything happen to our economy that disadvantages them. So I agree. It's an emotional thing, and people have political views. I've had people come to me and say, Biden's totally screwing up the White House, and therefore the economy is going to crash. Trump's, screwing up the White House, and so the stock market's going to crash. And to me, it's obviously much more about Federal Reserve and monetary and economic policy, as opposed to what any one individual is doing. But it's to your point about emotion. I had a client come to me the other day and say, as soon as Biden took over office, he crashed the stock market. And I was like, what do you mean? Like after the pandemic crash, obviously stocks had already started to recover, but Biden happened to take office at the same time we got a vaccine for COVID. And the market did quite well at the end of 2020 and into 2021. It wasn't until 2022 that we really struggled. And frankly, if I don't know if you have a chart handy or whatever, I can forward it if I can find it. But there's about a 2-year lag between when inflation started to rise and the Federal Reserve started to do anything with interest rates. So I would argue that's not necessarily a political issue. That's more the Federal Reserve was way behind, and I think there's reasons for it. I'm not saying there was no reason, and they were totally unjustified in it. I think they were still paranoid about a shaky economy coming out of global economic lockdowns. But people just let these emotions get a hold of them and start to sort of have these thoughts that are not necessarily based in the fundamentals of how the markets work.
Yeah, I did want to kind of point something out that I was kind of looking through this. I wanted to share something we talked about. I pulled this up after with hyperinflation. So here's an important chart. Keep in mind, this is the velocity of money. And I don't talk about this enough because it hasn't really been an issue lately. But the velocity of money is basically, if you look at inflation, this is something to keep an eye on. This is like one of the indicators I keep in my back pocket. So if you're worried about hyperinflation, if you're worried about things really getting out of control, look at this. So if you look at pretty much from 1960 until about 1990, it was flat, right? Just and by the way, velocity of money is essentially the number of times that the dollar goes through the system. So I have a dollar, I pay Tim, Tim pays somebody else, that other person pays me. That's like one run, right? It goes around once. The more times it goes around, then the higher the velocity of money, right? It means more people are spending and they're giving away their dollars quicker. If I keep the dollar in my bank account and just sits there, velocity of money slows. So effectively, there's some amount, some number in how they calculate it that it was like right around 1.8. And then it spiked up in the 90s to like 2.2, and it's dropped ever since until 2020, where it went down to like 1.1. Now it's rising back to 1.3. Now, I point this out not because it's going to be relevant to most people, but because of the fact that you want to see the trend, right? So the trend, it was dropping and then it really dropped, and say, well, not worried about inflation at the moment because the velocity of money is slow. So they can print all the money they want, but the velocity of money is slowing. So it counterbalances the effect. So you can print $100 quadrillion, but if velocity of money is at zero, it doesn't matter. And the way I equate it is, you basically print up $100 quadrillion, you stick it in a bank vault, and you lock the door and you keep it there. Is there hyperinflation? No, because the money, even though it technically exists, it doesn't exist because nobody's using it. So you might as well, and I like to use this as a visual because most people think printing money is bad, it equals high inflation, that's going to go through the roof. Things are a lot more complex than that, right? So if you think about that example, I'm going to print up $100 quadrillion, stick it in the bank vault. So yeah, we've got all this money in circulation, but it's not really circulating, right? This is why the velocity of money is important. So if you start to see this pick up, which we have in the last year, things are starting to pick up. Well, now you've got to start watching it. Is it going to go above the trend line, which we have a little bit more to go, or is it just going to like go back down to where it was before? Now, if this continues to go up, you could say, oh my God, that's terrible. Maybe. But remember, the Federal Reserve is actually destroying money right now, right? They've been printing money for decades and decades and decades. But as of right now, they're technically destroying money, right? They're taking money out of the system. So the velocity of money picking up, not such a big deal, right? Because it's counterbalancing the amount of money they're pulling out. Now, is it counterbalancing it perfectly? Not necessarily. I'm not going to get into the math of what this actually looks like, but I want to just illustrate the fact that inflation is really important, right? It's important for the country as a whole, but it's also important on a daily basis. So this is the example I wanted to show here is just the fact that how important the velocity of money is, and the fact it's picking up by itself is not important. Now, if it's picking up and they're printing money, then I'd be worried, right? But because they're technically taking money out of the system, it's not as worrying because it's balancing itself out. Now, another point I wanted to make here, and let me just shut this off so I don't share that. I wanted to get into real estate a little bit, and then I wanted to talk about. I saw a meme on I still call it Twitter, but anyway, the other day, and I can't find it, and I wish I could because it was hilarious. And it was basically, it showed the amount of inflation that we've had in the last 2 years, which was quite significant. Prices rose significantly, and now prices are not now prices are like topping out, right? It was 10% or 9.3, I think it was, and now it's only like 3%. It's like, oh yeah, we've conquered inflation, and the meme was basically it showed price rise significant, and now it's kind of like flatlining. But the problem is wages haven't done that, and people haven't made that much more money. So even though inflation is less now, we still have a big gap from the wages and where the prices are. So people can't afford goods, they can't afford services, can't afford to buy more expensive real estate. I mean, the economy has effectively ground to a halt in a sense of spending, right? People aren't spending more because they can't, because their expenses are going up, their utilities, their real estate, their rent, all this stuff is going up. The cost of living, basic essentials of living, which I also laugh at because the Federal Reserve doesn't look at the volatile items of food, energy, and what was the other one? Not housing, but anyway, food and energy. Basically, they don't look at. It's like, well, that's what I use to live. Like, I put gas in my car to get to work. I put food in my body so that I can wake up tomorrow morning. Like, these are things I need to live, and you don't count them. So, there's obviously a big problem in the math. But I do want to. There was one thing I saw on. There was a tweet I saw the other day, that was by Andy Warden of Intercontinental Exchange, and he basically said one of three things has to happen to bring affordability back to pandemic levels. And I want to bring this up because it's tooting my own horn because I've been saying this for the last 12 months. But anyway, I did want to point it out because it's someone else other than me saying this, and it's not just me pontificating. This is actual fact. So the way he says is U.S. incomes, in order to bring back affordability to pre-pandemic levels, U.S. incomes would need to spike 55%, or U.S. home prices would need to fall 35%, or mortgage rates would need to drop by 4 percentage points. Well, that's none of those things are happening anytime soon. It's going to take a while for those things to happen. So, and it could be a combination of all three, by the way, right? We talked about it. It's price, it's interest rates, and of course, it's affordability or income. So all those three things need to be adjusted. Now, could incomes spike 55%? Yes, they could, but probably very unlikely considering the environment we're in. Are home prices going to fall? I think naturally they have to. New home prices are now really close to the same price as existing home prices, which why would you buy an existing home if you buy a new home for the same price? Both of which are expensive, but just to let you know that existing home prices aren't moving, which is part of the problem. So they could go down, but they're not going to go down quickly because a real estate cycle is typically 5 years. Mortgage rates could drop. So if we go into a massive recession, interest rates could drop, mortgage rates could drop, and that could solve the problem. But I think realistically, it's going to be a combination of two of these, which is home prices and mortgage rates dropping is going to be the result. So there'll be somewhere in there that happens. But at the moment, none of those things are budging. So you just count your chickens that this is going to happen sooner than later because it has to. Otherwise, the real estate market is still frozen. There's no supply out there because people can't move. Why would I move somewhere else if I'm going to pay the equal amount or more? For the baby boomers who are downsizing, you're not downsizing. You're going to pay the same price. So why bother? Unless you're paying all cash, which does happen. New homeowners, first-time homebuyers can't get in because they can't afford it. You can't afford to buy a new home price because everything's way too expensive. It's a problem. It's not going away. And at some point, things have to change. The markets will cause that to change, and hopefully it's not going to happen quickly. Slowly is a better solution, but quickly would be a credit event. Let's just say. So, Tim, final thoughts from you before we wrap it up.
Yeah, so the real estate is really important because it actually loops back to what I was saying earlier about why markets cheered what happened on Friday. So even though we added more jobs than expected, wage growth was slower than expected and unemployment was less than expected. But I think where people get excited, and this is the importance of real estate, Wage growth, year over year wage growth, average hourly earnings on Friday were shown in September to be up 4.2% year over year. If you look at the core forecast, core CPI forecast, that'll be out Thursday at 8:30 a.m. Eastern time. If the core inflation number comes out at forecast, it's at 4.1%. So that's spot on with wage growth year over year. And if you look at the forecast for CPI, not core, meaning not excluding food and energy, overall headline inflation, that's at 3.6%. So if that number comes in, then wage growth is actually higher than inflation, but it ignores the pockets like you're talking about. So what's the number one thing people spend money on? What's your biggest monthly expense? I mean, unless you're me and you have a kid at an expensive college, your biggest monthly expense is your mortgage. And I have actually a friend and a client who's trying to sell her house here in Connecticut. And, it's been a few weeks and she's like, what the hell? I thought this was a layup. You just put your house on the market and it gets snatched up in 1 or 2 days. And I said, well, your challenge is interest rates have spiked over the course of the last 6 weeks, probably pretty much ever since you put your house on the market. So people are looking at a $500,000 house and saying, yeah, I mean, if my mortgage rate was at 3.5%, that's a no-brainer, but it's not. It's between 7.5 and 8.25, and that adds an extra $500 or $600 a month to my mortgage payment. I can't afford that house. I've got to go look in a new price range. So I do think it's important for folks to be looking beneath the hood a little bit, because everybody gets all excited. Hey, wage growth is this and inflation is this. Yeah, but if you look at a chart of inflation and break out all the different segments, like food and housing and energy and all of those things, I mean, one line's like this and one line's like this and one line's like this. I mean, they're all over the place. They're totally scattered. Looking at the average is like, I would say looking at the average with a number like that is like talking about what Earth or weather is like on planet Earth, right? I mean, it depends on where you are. So.
All right. So, well, Tim, as we wrap it up here, where can people find more about you?
Yeah. So all of our contact information and everything about our mission, how we invest for people, our endeavors to keep fees low while providing more services is all available at www.metricfin.com. All of our contact info is up there. You can schedule an appointment, and we'll always make ourselves available. As always, thanks, Kirk, for having me on.
Yeah, thanks for coming on, Tim. And that's the show for this week. Thank you again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On their website, you'll have access to the show notes, resources, and the archive shows. Also, we're now on YouTube, so please check out the YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a short rating and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send him an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything, but I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.